Hi, everybody, and welcome to the 333 Premia webinar of HDFC Securities. I'm Payal Pandya, Investment Advisor, and the subject today is Infrastructure Reboot 2.0. To discuss infrastructure with us, we have Parikshit Kandpal, who has been tracking this sector along with capital goods and real estate for over 15 years and is associated with HDFC Securities for about half a decade. Welcome, Parikshit.
Thanks, Payal. Good to be here to share my views with the investors.
Thanks, Parikshit. So, Parikshit, taking cue from your report itself, the most recent one on infrastructure, uh, we understand that despite the pandemic and whatever hindrances that it could have caused, the NHAI order awarding has been very robust and it is likely to surpass FY20 levels pretty soon. And of course, then there are a lot of positives like the NHAI easing working capital for developers. Then there is increase in fuel cess, which will add about a trillion annually to the fund to fund infra. And then there is asset monetization, the Atmanirbhar and national infra pipeline, and all of these. Like there are a lot of positives. So what when we see the picture looks very rosy for infrastructure, but just like roses come with thorns, what according to you could be the challenges despite all these positives? What are the risks when everything looks so rosy?
See, typically in a construction company, so for the sector like construction, the biggest risk which we perceive is the macro risk. So one is that the interest rates suddenly start going up and RBI goes for tightening. So that is one risk which could bloat up the cost for interest cost for these infrastructure players. Second thing is on the fiscal deficit side. So in a scenario where we are still fighting with the COVID and we don't know how the second half will emerge, so still very limited clarity on that. Government tax collections has been low. States are also fighting for the fair share of GST compensation, which government has not been able to give because of the tax shortages. So then what happens is government has to have a fine balance between how to manage fiscal and also keep on doing ordering. So because ordering involves a lot of capital expenditure on account of the government's balance sheet. So they will have to then see whether if this thing basically continues for another say 6 months or 12 months and we are not having a vaccine by early next year. So obviously then there could be some tightening on the ordering. So this year maybe there's good ordering, but then again on the payment side, government will be constrained to make any payments and they'll slow down payments if the tax collection doesn't improve. I mean, there is an extent where till the government can borrow. Okay, so it's more of how the pandemic plays out, how quickly it gets addressed, how fast we can get a vaccine, how people and how the things move towards normalization. So as of now, what we are seeing is that this month onwards, the normalization has picked up for most of the infra companies. The labor levels are almost back to almost 85-90%. So third quarter onwards, we would see more of a normal execution. The interest rates are at all-time low. Inflation has, we are seeing inflation, initial inflation going up, food inflation going up. So there are concerns which people the economists are having that there could be reversal and RBI may start increasing interest rate. Very initial thoughts and initial risks around that. But as of now, I think globally the banks are banks like Fed are talking about they will go to any extent to support the economic growth. I don't think right now RBI will go and take a diversion and start increasing interest rates. So we believe still that though the yields have been hardening, we still believe that RBI will not immediately go for increasing interest rate. So you have to have a fine balance between the two. The monsoon has been good, so which will support the rural income. So government may not incrementally have to support too much on the rural side. So for recovery, what government will do is they will have to give more infrastructure projects because infrastructure sector is a large creator of employment and large creator of unorganized employment. So these are typically blue collar jobs. These are not white collar jobs. So and these roads are more horizontal development. They touch through rural areas, rural India. So there is opportunity for laborers to get jobs. So five large labor supplier states are Bimaru states. So Bihar, MP, your Rajasthan, your UP, so Odisha, West Bengal. So these are the large providers of laborers. So government is also wants to give a stimulus by stepping up capex on the government side because there is a lack of capex on the private side. plus there's employment generation which these large infrastructure projects bring in. I would say risk more on the macro side. If the pandemic extends, if the vaccine is a little late, obviously then government will have to rethink their spend and they need to cut down on expenditure. Maybe next year ordering may suffer, but as of now it looks too much, very much in under control. The way the things are going and the way the vaccine has been is getting developed. We're looking at an early next year kind of vaccine coming out and then things getting towards normalization. Yeah.
Okay, that's sounding like quite a relief for the sector as well, with a lot of things in place. Now, when it
Right.
comes to infrastructure, we see that the road sector is one of the largest pie in it, correct? And in the
Yeah.
recent past, we have seen a capex of somewhere close to 2 trillion annually, which now in
Yeah.
the next 5 years is likely to be somewhere around 4 trillion annually, coming to
Yeah.
a total of 20 trillion.
Yeah.
While investments obviously will flow into the sector because of all the positives, and wherever we think that the return is good in this aspect, because everything falls in place. How is the how's the execution picking up? While you have obviously mentioned that about 80% of the working class has returned, and that's how execution is now picking up and is likely to improve from Q3 onwards. Do you see a risk of, this sector overall going through the execution trouble that it went through a few years ago, where a lot of stalled projects had been, witnessed, and while there was investment, there was it a lot of money got stuck because of lack of execution.
Yeah.
How do you see that?
So if you see last the year after the NDA came 5 years back, 2014. So yeah, so almost a decade was lost. I would say the policy flops, land acquisition issues. So the projects were being given even if the land was about 40% acquired. Okay, so the
Hmm.
government acquired 40% land. They awarded the projects. These projects, the construction work started, and in between there was no land, so projects got stalled. And there were time overruns because the land was not acquired on time, and there were cost overruns because your fixed cost on the projects are idling because you don't have land to execute work
Hmm.
on. The government in 2014 came out with the HAM model, and they changed the model concession agreement so clearly for both EPC projects which are giving on cash contracting basis plus on the hybrid annuity model. There was stringent provisions of land acquisition and has to be about a certain percentage, about 80 to 90% has land has to be in place. Okay, by the time the project execution starts, there were clear provisions of delinking of land or descoping of land which is not acquired after the project as a substantial level of execution. So towards the end of the
Hmm.
project, if still the land is not available, they will descope that from the work scope of the contractor. Okay, and the project will get completed on time. So the stress of the new model concession agreement was that substantial land of 80% plus should be in place. Secondly, if the within 6 months of the work getting started, if the balance land is not available, it can be descoped from the project. And since the highway has to get completed, if this land is not available, so what government then finally towards the end of like 2018-19, they came with a policy that they entered into a supplementary agreement with the developer that if this balance land we acquire say over next 2-3 years, then you have to come and complete the balance works. So this sorted out a lot of contentious issues regards to cost and time overruns and litigations and arbitration. So we have not really seen the major arbitrations in last 5 years. So whatever arbitrations are going on currently is all like historical, maybe a decade old. A lot of issues were
Hmm.
ironed out by this government. So execution now going ahead with this kind of ordering is dependent on two things. One is the labor availability at site. Okay, right of way, which is the land acquisition should be in advanced stages while the project gets started. Third thing is funding should be in place. So both on the equity side as well as the funding from the banks and financial institutions and from the client like NHI. So that is the only thing. I don't think India has an issue with regards to population or labor availability. We have enough which can be mobilized for a site.
Correct.
Funding situation has improved. And in fact, the pandemic, what it has done is that the NHI has started giving better terms in terms of payments to these contractors. So earlier they used to pay based on a milestone-based completion. Now they've gone for a monthly completion, which will aid cash
Hmm.
flows for most of these developers, which they can plow back into execution and speed up execution. So I don't see as of now any major challenges. The only thing was on the banking side, because some of the private banks have had issues after the NBFC crisis, and which has impacted them and their own funding, and it has to an extent impacted the depositors' sentiments, and they have chosen to align with some of the larger banks. So that has reduced some of the private banks' funding to these projects. But I would say larger PSUs, banks' balance sheets has improved significantly over the last 2-3 years. They are back in the market, and they're also supporting some of the lending. So for more larger organized EPC contractors, we don't see any funding constraints. So they are well supported both by private banks as well as by the PSUs. So even they've been able to raise funds from the market. So I would see challenges for more of a tier two developers, more smaller developers who have got bloated balance sheet, have had issues in terms of corporate governance. So they would find it challenging to raise funds. But larger organized players, I don't think funding is right now a constraint, because the larger banks are chasing them. And most of these stocks which we have mentioned in our report are literally debt free on the standalone level. So don't see any issues for them to raise funds. So the challenge remains funding. If it's not a major challenge, then labor was an issue which happened because of the migration. But I think labor has now started coming back, and ordering has been much better than expectation. So even we were positively surprised the way the ordering happened after this pandemic had hit us. So till July, August, the ordering has been very robust, much better than expectation of us and even the market. So that has been one of the very positive surprise, which should lead to conversion of these orders into revenues and growth over next, I would say, from second half onwards. We will see substantial growth coming in versus the expectation we had earlier, and next year will be very strong for most of the companies.
Okay. So coming to this robust ordering, and now since with 80% of labor coming back, and execution seems to be a lesser worry compared to the earlier times, obviously the existing large pipeline gives us a decent revenue visibility for say about 2.5 years, right? After that, a lot of
Yeah,
companies are now, sorry, you're saying something?
yeah. So now I would say some of the companies about 3.5 years, some of them about 5 years. So anywhere
Hmm,
from like minimum 3 on an average, you can say. So yeah, you're about there. Yeah.
correct. So on an average, say 3 to 5 years, a
Yeah.
lot of companies have started diversifying, like into another infra related sub segments other than the road projects, which would be water projects or railways or airports or whichever. So do we expect that over a, a term of say 3 to 5 years or whatever, road as a subsector will have much lesser a pie, and then if that is what we should expect, then which is that another sector which will become the rising star within infrastructure gamut?
See, in my report, we have mentioned about the national infrastructure pipeline. So there
Hmm.
again, roads is almost 19%. So it is still, I think roads will continue to remain a very significant
Hmm.
sub-segment of the entire government infrastructure rollout. So national infrastructure pipeline, if you map it with the roads outlay there, it's about out of 111 trillion, about 19 trillion or 20 trillion is for the roads. So still, if you travel the length and breadth of India, so India has really not developed to the extent it should have by now. Government's push for manufacturing has to align with the infrastructure creation. Without that, that cannot
Hmm.
gain traction. We need to reduce the logistic cost. We need to reduce the land cost. It can only happen if we come up with more greenfield alignment, more greenfield expressways, and the land around that will be basically available at a very good price for the manufacturing setup, okay, to happen. And plus, they have to
Hmm.
connect a lot of rural places which are still don't have connectivity. So they will have to keep developing the roads. The overall national highway program was envisaged initially with about 65,000 kilometers to be built out. Out of the phase one, we have about 25,000 kilometers, which is currently under implementation. I would expect by FY23 or 24, this entire development will be awarded. And by 27, we'll have all these roads completed. The government will then come up with the phase two of Bharatmala, which will be about, I think, 35 to 40,000 kilometers, about 7 to 8 lakh crores worth of awarding, which will happen. So road will remain a core area. It will come down as a percentage of order book for most of the companies because they have planned to diversify with the high revenue base. They have to keep growing and they cannot just keep growing with the road order book. So they are, I would say water will be one. So potable water, irrigation, that will be one. And how we harness the overall natural resource like water, and we store it and distribute it across India. So I would say distribution of water either through irrigation canals or irrigation related works. So that will pick up substantially. We will see a lot of dams being built for states to meet their own water requirements. Plus potable drinking water, the Jal Jeevan mission, so which the government has. So that is basically they will spend money out there. So water will remain a big part. Modernization of railways, Indian railways will be a big again a segment. Even within that urban infra, the metro projects, each of the states are having, they want to spend on metro. At least the key cities, large key cities will have large metro projects getting awarded. We are seeing a trend towards that. So power related infrastructure works, we will have huge outlays there. Then building out institutions like AIMS, IITs, so health and education. So these two sectors will also see a large outlay from infrastructure side for creation of health and education infrastructure. Then new refineries, new ports, new airports. So these large infrastructure projects will also see some. Besides that, manufacturing hub, as I said, government will create large logistics parks. They will give some tax incentives for the multinational companies to come and set up their manufacturing facilities here. So these are the largely the new segments which we will see getting increased traction and will get aligned with the NIP program of the government over the next 5-6 years.
Okay, so we should expect that all the kind of sub-segments are, expected to grow in tandem with the overall growth in infrastructure. So in this, then we do
about roti kapda, makan, and bijli. So this has been the most important essential necessities for a country, any country. So I think this more or less aligns your road, your electricity, your housing needs. So there's a large big push on affordable housing. We have seen the Pradhan Mantri Awas Yojana, huge awards happening. Maharashtra last year had almost 20, I think if I remember, memory serves me right, about 30,000 crores of awarding happened only in Mumbai, developing affordable housing. So in one city, one city. So I think larger cities, capitals of these larger states, more of affordable housing projects coming on board. So yeah, the government is looking at roti, kapda, and makan and bijli. So I think these are the basic necessities which a government is bound to give to their citizens. I think that a lot of stress is there to basically give out these projects, and it also has a potential multiplier effect on GDP growth and employment creation. So it gets entirely and linked with each other.
Correct. Going a little stock specific, we have seen that largely most of our covered infra stocks have almost doubled from their April lows. So while they are of course still much lower than their 2018 highs, so we would on one hand be able to say that there is still a lot of upside there, obviously, with of course the large pipeline and revenue visibility that's coming in, plus execution improvement and everything falling into place. How do you think these are placed in the sense that despite doubling over the last few months, or from what time horizon should we see these now? Since we have a buy view on all of these, so how do we categorize these? Which are the ones which we would look at from say a mid-term perspective? Which ones should we consider from a longer-term perspective? How do we bifurcate in all of these?
Okay. So we have mentioned our topics in the coverage. So we have shortlisted some companies where they don't have any debt on books, literally zero debt.
Hmm.
They have the valuations are supportive. They are about less than 6.5 times on 23, about less than 5 times in FY20. So 22 and 23. So less than 5 in 23 and about 6.5 or less than
Hmm.
that in FY22. So the stocks have run up. So there was a huge pessimism which was built up after the COVID hit. We have also downgraded the multiple for most of the stocks and earnings also. But the first quarter itself was a big surprise outperformance for most of the companies, and we have in this report upgraded the earnings for a large part of the coverage universe. We could not estimate that the cost cutting measures which these companies have taken in the first quarter, they could retain a part of it going ahead. The recovery is also panning out. The ordering has also surprised us positively. So the multiples, if you see the cross cycle multiples on valuation, has been on an average about anywhere from 12 to 15. The bottom has been about 4 to 6. So still we are in that range of 4 to 6 at the current prices. We believe that the peak ordering is still some time away. Maybe we are looking at somewhere about mid next 2 years we will hit the peak ordering, and last year maybe government will again shift a large part of expenditure towards social infra going into the elections. Okay, so we have about 2 years to play this theme, at least something on the worst case or most conservatively putting it. So we have
Hmm.
really not seen these companies were 50% higher from current prices when their order book was almost half of what it was today. It is today or it will be by this year end. So order books will double. Are other sectors which are looking good in terms of ordering. As I said, non-road segment. So ordering may surprise positively. So there is growth upside even to the earnings which we are currently estimating. As of now, we don't have a
Hmm.
visibility on how that will happen. But I think gradually over the quarters, as the ordering, which has surprised us, picks up further, so there could be upside risk to our earnings estimate, and which may still look the valuation more depressing. So tailwinds in terms of NHAI bettering the payment terms to the contractors, tailwinds of lower interest rate, tailwinds of asset monetization, which may happen over the next 2 years, which will free up a lot of equity for most of these guys, which will make their balance sheet look still better. So that's already supporting a bottoming out from here. So I would say the downside looks very limited from the current levels. Upside will be driven by these tailwinds as we move into quarter-on-quarter basis and as the execution normalizes and these companies come back on growth. So
Hmm.
net-net, we believe that playing all these factors positions the sector for a re-rating. It has happened every year. It has happened year on year. So we have seen these valuations and multiples mean reversion will happen. We expect it to happen over next 2 years. And so these 6, 7 names which we have highlighted are the stocks which give you balance sheet comfort, as these companies have decent kind of corporate governance, nearly net cash. They have strong monetization pipeline. Most of the assets are monetized. They have strong order book capabilities and execution. They are well supported by the best of the banks in the private sector on the PSU side in terms of funding. So that's the theme. That's how our positioning is on these stocks. So I would suggest investors can look at adding these stocks for a horizon of next 1.5 to 2 years, looking at a decent upside, which we have already given our target prices on these stocks.
Okay. What more do you want uh, an investor to understand, other than the fact that everything is positive and that we can look at it from a 2 year perspective, and that, I mean, coming to one concern that comes to my mind is, if we say that the order booking is yet to pick up and it's yet to peak out, which is expected to, and we are already uh, quite high from April lows, and however, the multiples haven't picked up as much yet, so we do have a scope. But do you think that the time gap wherein multiples actually pick up, as in the new orders and all start showing in the P&L of these companies, which will effectively, help raise the multiple. And the current price run up is the gap in between these two. Is it likely to bring in some correction, because this run up has become a bit too quick, too early, that types.
No, so see, run up, as I said earlier, also there has to, we do play in extreme, market goes to extremes. So maybe if they have corrected 50%, they would have recovered 25% if you have the fair value. So if stock like Capacite has corrected from 400 to 180 rupees, from 80 it is at 125. Okay. So as I has positioned it, that risk reward right now, so I don't see the tailwinds will, which are there. So downside looks to be limited for me in case there is a market correction, market wise, Nifty corrects or BSC corrects. So obviously these stocks will correct. It's not that they are immune to correction, but risk reward is, as I'm saying, these tailwinds position the sector because ordering for some of them have already, they have crossed. So KNR has already exceeded the last year ordering. So last year they got 2,000 crores of orders. They were already about at 4,300 crores of inflows within the first 3-4 months of this financial year. Okay, so I'm saying ordering will translate into numbers, and there is upside risk to our EPS estimate. So the maybe P right now of 5 times on 23. So I don't know how much investors will expect, how much it can go down, but they have traded at as high as 15 to 18 times. So from 4, a target multiple of 15 or trading multiple of say 13, even 12, 13 is a big upside. Downside wise, 4 can become 3. So maybe it can correct that much. But risk reward is favorable on the upside because these tailwinds will basically support that re-rating of the earnings and the multiple. So there is both upside risk on EPS and plus valuations are supportive. So that is what I am trying to position here. Balance. Yeah.
This is very comforting, Parikshit.
Yeah.
Before we close, what is it that you would want to add?
Yeah, so I think this is one of the neglected sectors. We have seen extreme valuation in some of the other sectors, but this sector are typically cyclical. So when you play a recovery theme, when Indian growth recovers, obviously the cyclical sectors do outperform. So right now the cycle is very different. We have strong balance sheet companies with depressed valuations and tailwinds, as I said, in terms of robust ordering, lowest interest rate, asset monetization. Some of the companies have got good corporate governance, and they have strong execution capabilities and are well supported by banks, the stronger private banks as well as PSU banks. So now, somewhere the multiple has to mean reward. It has happened. History suggests that it will happen here in this case also. So I would say there's a comfortable risk and reward available for the stocks, new topics which we have mentioned here. So investors can position their portfolio. Maybe a small allocation can be done to these small and mid caps, which will give them decent returns going into the next few quarters.
Okay, that's very helpful, Parikshit. Thank you very much for having a discussion with us today. I hope this has given a lot of idea to all the investors on infra as a sector and where they should invest for the next few years.
Sure.
Thanks, everyone, and have a great weekend. Thanks, Parikshit.
Okay, thank you. Thanks, Payal.